And for our first Startup Grind virtual, we have the honor of having Marie-Hélène Ametsreiter from Speedinvest. So to get more of an investment perspective on what this situation that's put us all in our homes and this lockdown has kind of how this has impacted the startup world. Before I get into the core of the interviews and ask the tough question to Marie-Hélène, I would like to spend a little bit of time, a couple of minutes, to tell you a little bit about Startup Grind for those who are new to our endeavor. So Startup Grind in Munich started back in 2016. We have now a team of 4 members. With me tonight is also Ulrike, Marie, and Philip. And Startup Grind actually is an association that started back in 2010 in Silicon Valley with the purpose of nurturing the startup ecosystem, providing a platform where startup founders, investors, innovators can share their stories and can get inspired. And we do this through local events on a monthly basis, which are usually, as you may know, on site, out in venues, not really virtually, but as everyone around here has had to also pivot, we also adapted to this current situation, and the reason why we are now doing this virtually, hopefully for a couple of more, but also going back to our ritual of having this in the offsite world. Startup Grind is present actually in 125 plus countries and over 600 cities. So once we get to travel again, you can also visit other chapters and get also an exposure to the startup ecosystem there. And this is what makes the strengths of Startup Grind, having this quite a great network of people interested in entrepreneurship, but also people willing to help and willing to nurture this this creativity and this ideation, which makes up all startups. And what of the best way to do this is also to help startups fund and to provide capital to these entrepreneurs. And this is the reason why we have today Marie-Hélène, who is an investor and an industry expert with us today, and who's going to tell us a little bit about herself, but also about how she's been supporting her portfolio companies and her entrepreneurs in this weird situation that we are facing with Corona and with COVID. So let me get now back into the screen. So welcome, Marie-Hélène. Thanks a lot for being with us. So Marie-Hélène, you started as a partner at Speedinvest in 2014. You are responsible for what we call Industry 4.0 and also for the Munich office. So that means you invest in startups that are active, if I'm not mistaken, in industry and construction technologies. Maybe my first questions would be to understand a little bit, what is the path that brought you to an investment activity and why industry? Because if I'm not mistaken, your background is or was rather in telecom. You started in different, or you worked in different telecom companies in the past.
Sure. So first of all, thank you for having me and for inviting me today. I've done a couple of webinars by now, and I know how hard it is to talk to nowhere. So, I mean, to everyone who participates today, please, I think we have a Q&A possibility. Send in questions so that we can, you know, get a little bit of feel of the audience and what you are more interested in.
Exactly. And that's a good point to actually start with this pooling, which I already forgot, which is to get to know our audience as well, so that we can actually adapt a little bit to their questions as well. So let me launch the first pooling, and in the meantime, you can maybe discuss a little bit how you came to investment.
Sure. So, as said, I definitely do not have a background in finance, and it was never the core of my interest. I was actually asked back in 2014 by the CEO and founder of Speedinvest if I would be interested to join. And that was the first time actually I learned about the term venture capital. Bit embarrassing, but that's the truth. So why I joined was, I think, specifically because of Speedinvest. So Speedinvest is not a typical venture capital company that is, investing money and then more or less a wait and see policy if the startup would succeed and grow. But we consider ourselves as an operational VC, and that means that we work very, very hands-on. We really collaborate and support our portfolio companies in different fields, from hiring to online marketing activities, especially business development, how to introduce them to corporates for sales talks and so on. And this is what I thought after 20 years of having worked in several different managerial positions, that I'd love to, share these experiences and pass on these experiences and support these with very young people. So this is how I ended up in Speedinvest back in 2014. And to your question on industrial tech and why this focus. So again, in order to support the startups in the best possible way, we decided at Speedinvest that we need to focus on a specific field in order to build up expertise for us, the investment managers and teams. But also we try to build up a network. So we do this with our LPs, so the investors that invest in our fund, that are also specifically then in this area, from this area. And we have one fund on fintech, insurtech, which was not my, as said before, finance was, or banking was not really from where I came. We have one on marketplaces. Also, I didn't have really any association to that. So industry and, also B2B world was something that I came from, that I learned, that I felt comfortable with. And that's why I ended up, and I think I've chosen a very interesting and promising field, because industrial tech, so everything around Industry 4.0, but also construction tech, is just at the beginning of the digitization. So a lot's gonna happen there.
Yeah, and we're gonna actually talk about a little bit of this acceleration of digitalization due to COVID. So let's find out who is in our audience. So if I share the result with you, we have a majority of startups, 47%, and also a couple of investors, and others, I guess, would mean then freelancers or agencies or tech, maybe tech people. So that's for the first call and getting to know our audience. So you were actually mentioning how Industry 4.0 is kind of your domain, your focus at the moment. What exactly do you define as Industry 4.0? What are the different sectors within industry, and how is digitalization affecting this industry, and what sparks your interest, I would say?
Yeah. Well, I think, first of all, from an investment angle, we define industrial tech quite broad. So how I try to explain it is that along the value chain of a manufacturing company, from the sourcing of raw materials and how you do that, the whole supply chain process, how you bring these materials to your factory, the whole production process, everything, how you bring that into product, services, whatever, and the automatization of this process and this production and manufacturing, up until how do I distribute these goods to my B2B customers, and even beyond that, namely the recycling of those materials or everything, you know, how can I maybe track the usage of these products. So everything along this value chain and startups that help either to enrich in the sense of make it more efficient, this process, or disrupt the process in the sense that existing business models may be completely renewed by other approaches, are areas we look at. The more we look at also construction tech, which has no classic, let's say, manufacturing part, but also a lot of similarities when it comes to supply chain, logistics, and so on. And also on the mobility side, we look on you know, mobility enabling technologies, I'd say. So not maybe the core part of automotive, but everything around that. Yeah, so why I believe and why I think this is so interesting, I mean, there is this classical S-curve development of digitization, and what you can see is that fintech and the media industry and so on, we have passed that and they are somewhere at the peak, whereas industrial tech still is at the very, very early stage and beginning. On the other hand, a huge value of the GDP in Germany, 30%, is generated in the industry via traditional classical industries. And only a couple of years ago, only 1% of VC capital was actually invested in industrial tech. So we have a huge mismatch of the value that is generated and also the money that is available from traditional industries and what has been invested into innovation and ventures. You know, accompanied by technological advancements and so on, I think we are at the inflation point at the moment that the whole industrial tech would really take off.
And Speedinvest is trying to bridge that gap between how much value there is in this space and how much capital is invested. So going back to a little bit of the topic that is around everyone's lips right now is how COVID and the potential recession that we're gonna live through are gonna impact our industries. Have you, like, first, did you imagine something like this in when you started the year 2020? And at this point in time, do you see this as more of a positive because it actually accelerated digitalization of your industries because people need to face lockdowns, contactless interactions? So I guess if we talk manufacturing, supply chain, your industries might have been quite affected. I'm just wondering, like, first, did you plan this? I think that's the first question. And how did you react to this? And how did you see more of the opportunity rather than the risk, I would say?
Yeah. So, of course, I mean, I think no one could have planned for that. That hit us, and no one could have foreseen it. We are actually in industrial tech, I think, in a situation we don't, in our portfolio, have real total winners that are completely not benefiting from the crisis. I mean, we see that in other industries or in other startup areas, like if you have communication startups or someone who is maybe in e-commerce, that of course got their direct crisis winners. We don't see that. We don't yet have anyone in logistics, so that might have had a positive impact. But also on the other hand, we don't have real losers or the one who are super suffering now from the crisis, such as, I don't know, startups that are in hospitality industry and so on and are directly affected. So what we see is very clearly a slowdown in the sales cycles, and that's, I think, very obvious. The big corporates and traditional industries, they have to fix in that crisis and maintain their core business running. and investments in innovations and new businesses is delayed in a way for now. And I think that is important, what you mentioned and said. We very, very much believe that COVID in the end will have a very positive and impactful impact on the development in industrial tech, simply for two reasons. First, after the crisis, everyone is reaching out and looking for cost efficiency possibilities. So they will look for technologies that help to produce more cost efficient and process around. So most of our portfolio companies are enabling and helping in increasing efficiency. And on the other hand, I think they also wanna try to bring or accelerate the automatization. So to reduce the risk factor of human being. I mean, imagine the whole automotive industry, if they would not have had human beings involved, they could have continued with their production. So in the end, and I think this is very true for our whole ecosystem and industry, I think COVID in the end will be a really, really booster to the digitization process. And as most of the companies that venture capital is investing or venture capital companies are invested into in the digital industry, I think in the end it will be a very positive effect. Takes time.
Yeah. And this is where I would like to actually get the view of our audience and see how optimistic are you now. So bringing another poll just to understand a little bit. So if we had startups in our audience today, and if they're feeling the same way as you, is that a chance? Is that an opportunity? Or is that rather a risk? And I just want to go back in a hibernation kind of. I'm guessing that when you, since nobody sees this coming and you had to basically reshuffle a bit of priorities, at least on our side, there was a huge pivot towards portfolio companies, right? So looking at making sure that, the companies that we've already invested in are safe, that they have enough runway, enough liquidity. How did your role change in terms of, deal making, sourcing new investment versus managing your portfolio?
Yeah, I think it's across the industry, and very, very clear that the first step you take as an investor is to secure your portfolio companies. So the full attention in the first wave was clearly on very heavily involving and discussing with each single one of the companies how the situation is, how they are impacted. So mostly you are looking, of course, how long still the runway would be. So how many months can they still survive with the liquidity that they currently have in place. And then with all of them, we did scenario plannings dependent on, taking assumptions, how hard it would hit them and for how long also the crisis would last. And depending on that, we then derived measures, very clear, straightforward measures on how we can prolong the runway. So that is true, I think, for almost all of them, simply to give them room to breathe. And I mean, from the measures, I think it's very obvious. Everything around cost cutting, how to reduce your costs, and that came from clearly Kurzarbeit, introducing short-term employments, then also freeze of hiring, of course. Also on free will basis, cutting salaries, and I really have to say that this was enormous and fascinating to see how many of the portfolio companies and their teams, especially also the teams, not just the founders, cut the salaries by 20-30% even, which was partly compensated then by ESOP programs. So I think that was a nice thing to do. So that was on one hand. On the other hand, of course, how you can prolong the run rate was simply on fundraising and how to get in new funding. And currently we are very much and very busy with understanding all these state support programs, and which one makes sense to apply for, in what circumstances, what are the risks involved. And I think that's a crucial one. What is the signaling maybe that you might then carry along with having the state in your cap table. So this is what we are currently very much engaged with. However, we never stopped looking for new investments, but clearly the shift in attention, I would say, from especially also my time, is at the moment 90% of portfolio and maybe 10% on new investments.
Mm-hmm. So let's share the results of our audience and how optimistic they feel, which I'm very glad that actually they're ready to fight. Let's put it that way. And they are very looking forward for this probably recession or crisis to be an opportunity, as you mentioned, for digitalizations, but also to maybe kind of have the right measures, because in our case at LIDEX, we saw also some readjustment that were necessary. And this crisis was the right timing to actually take the measures to focus on the core of the business, maybe refocus certain spendings, or refocus certain areas of investment. So we've looked at this as well. I would be actually interested to hear the audience as well here on what type of measures, since we have actually more of startups here, what type of measures they introduced to tackle this crisis. And some were mentioned by Marie-Hélène, so short-time work, product adjustment, pivot, layoff, of course, further cost reduction, like the salary cut that you were mentioning, Marie-Hélène, some emergency financial aid, so getting access to some support schemes from the government, and of course, funding round when that was possible, special funding. One thing that you didn't mention, but I saw this in a couple of our portfolio companies, is the product adjustment. So I saw quite a few portfolio companies, and maybe also because we focus on hospitality tech, so they were a necessary readjustment here. But I saw a lot of companies pivoting, kind of getting closer to their product market fit and trying to kind of test new concept. Did you see this a little bit also on your portfolio?
Yeah, definitely. I think one clear strategy was to reevaluate the target segment and try to readjust in order to focus on the winners as your target segment. So we have a couple of companies that were clearly having as their prime target group automotive, because that's a big industry, of course, with lots of money in Germany. And definitely this is not the target segment at the moment that you want to address. And certainly for that you sometimes need a little readjustment. If it's just the sales materials and how you communicate, or is it even more in the product positioning? So that's one thing. The second thing is, of course, the adjustment in how you do your sales. I mean, a lot in this B2B, more complex products that our portfolio companies would sell. You usually work a lot with demos. You usually try to have workshops in order to understand the customer pain and the situation there. So it's intensive onboarding processes and sales processes, which all of a sudden is not possible anymore. And I think this was a challenge for a lot of them, to go to pure online sales methods and still try to build up the trust. I mean, first get the attention for the topic, and then secondly, build up the trust level to enter or to conclude on a trial or on a pilot and take the next step and really convert in a sales talk to the next level.
Yeah, I guess the remote onboarding has been something that a lot of our founders have also looked into, to make sure that there is a possibility of not probably being on the ground, but creating that awareness and that trust even from a virtual discussion. And also virtual negotiation is another aspect that people also had to tackle and to get good at. So ending the poll here to understand a little bit what our audience has been taken in terms of measures. So short time work, of course, Kurzarbeit in Germany, to be able to reduce some of the employee costs, product adjustment and pivoting. So as you mentioned, Marie-Hélène, reevaluating your target segment and maybe adjusting your product accordingly. And some actually didn't do any layoff, which is quite, I think it's also the fact that here in Europe, at least, we have very strong governmental support with the short time work and the Kurzarbeit. And so people are not forced into layoff, which could be the case, for example, in the UK or in the US. So sharing that with you. You were mentioning earlier that most of your time, so 90% is really focused on portfolio. Does that mean that you're not looking at any new deals, or that you're not accepting any pitches, or how does that work now?
No, actually, we would love to look at more pitches. We see that there is a slowdown in the deal flow. So there is not as many startups applying actually for funding. And it seems that's an overall phenomena, that because there is a buzz out there, VCs are not investing at the moment, and therefore, it seems they're not even trying to apply for funding, at least for first-time investors. So first-time funding, first round, seed rounds. We are, and I think we have to differentiate here. It depends very much what stage a fund is at and in. So if you have just closed your fund and you have had 5 years of investment period, your pockets are full, there is lots of money there that you have to invest. And these funds are still open, definitely, for investments. And there is some nice resources, even on the internet, that you can look up and see which funds have closed recently. Some big funding rounds, so first close, second close. And as a recommendation, I think, if you are in fundraising mode, let's try to approach these first. Likability is much higher. The other funds that are, let's say, halfway, of course, are very cautious at the moment to deploy these remaining funds that they have for new investments, because first they want to see and know what's with the existing portfolio. Depending on how long the crisis is, of course, we also will help and support primarily our existing portfolio with some bridge financing or some in-between financing round to help them survive this crisis. So I think, yes, we definitely are still investing. And Europe is in a better condition here than the US. We have a US investor, NEA, fund of fund, that we exchange views on a frequent basis. And in the US, it is really at the moment a complete freeze in new investments. That's kind of a phenomena because the crisis that they were hit before, I think they learned their lessons. The crisis usually take much longer. Yeah, so till year end, I think there is, so Europe is not that strict in that.
Yeah, coming back actually to a point you made about the structure of a VC fund and the fact that you have a certain time to invest and a certain time to only do follow-on or divest. I'm also looking at the portfolio companies because I'm guessing that if the fund that you invested from into these portfolio companies is arriving also at maturity, then would you be able to inject new cash from a new fund that you raised?
Unfortunately, I have some connectivity issues. I didn't hear the complete question, but I think it's, I got it. Is it about crossover investments? Would we invest from one fund?
Exactly, crossing funds when you have a portfolio company that needs maybe a bridge financing, but the fund that you invested in from is arriving at maturity.
No, we are not allowed to do that, and I think no one is. You usually don't do that because this would support the idea of, you know, make it look an old portfolio good by investing new funds from a follow-on fund into there. So that's a no-go. However, as said, if you have from the same fund still some, you know, reserves available, you can of course do that. And on top of that, at Speedinvest, we are currently raising an extension fund. Mm-hmm. So especially from SI2, where we have 150 investments, and they are the majority, I'd say, of companies that were hit are funded from. We are now inviting the existing LPs to invest into the extension fund, and then with this money you can help and do some follow-on investments.
And that would be secluded for the portfolio companies that you have in the primary fund?
Yes, yes, exclusively.
Yeah, exclusively. Because it's true that even though we've been through this couple of months of lockdown, and the situations on the public market even have decreased by 30%, we see still funds raising, right? I think we had, a German fund just raised 200 million very recently, also I think focusing on industry. Is this money available? I mean, they will have to deploy it, right? So there is still funds investing and not so much focusing on portfolio companies. So that should be the target.
Yeah, I think both is true. On one hand, you have new LPs, so investors that are investing in funds. You can raise a fund these days. And if you look in history, actually, the vintage years, so when funds were started, when we had the dot-com bubble and crisis, the ones that were started in those years were most successful vintage years. And this is usually because, you know, the valuations go down, you can start and invest actually at quite preferential terms. And with that, you can uplift the performance of your fund. So, and there is a lot of, you know, there is this saying, you can really make a fortune when you invest at risk, so not against the cycle and in the crisis. And I think this is true. There is a lot of investors out there that are especially now looking and invest into funds, into new funds. And from the fund itself, there is, even from before, lots of dry powder out there, lots of money, and good companies will always be able to fundraise. Is it first-time founders or first-time rounds, so seed rounds, or is it later stage investment rounds? So I don't think at the moment, maybe there is a short-term slowdown, but I don't expect that there will be no more funding.
And when you say good companies, do you think the selection criteria for what you would say is good have slightly changed? I mean, we talk a lot about, you know, at the pre-COVID, we were talking a lot about top line growth, so revenue growth. Now we're looking at, because cash is king, as we know, for liquidity, then profitability. Have you changed at Speedinvest your selection criteria for investment?
No, I wouldn't say so. I think, I mean, firstly, I don't come from the VC world. I come from, you know, hardcore operations. And I was always a deep believer in organic growth, and I don't think that you can overstimulate unorganic growth by just pumping lots of money in. There will come the moment of truth. So I think a healthy growth curve with always looking at margins and the development is something we've always been doing, and especially in industrial tech, there is also not such crazy hyper growth cases possible, because just by the nature of the business, how you sell, it is not just by downloading a software or an app. Are you using it afterwards or not doesn't matter, but it is, to sell a product, it's really hard work, and it's not so easy, and then usually you never do that for free, but the revenue is there immediately. Nevertheless, of course, what you're looking at to have a healthy mixture in your portfolio between, we always call that, let's say, the low-hanging fruits, so companies that generate a direct positive impact and that can generate and become profitable quite quickly, whereas other cases that are momentum cases where you maybe invest more in a technology or in a vision or in an idea that you cannot monetize within the next 3 to 4 years. And these cases, I think, it depends very much what area they are working in. I mean, if this is something, as said before, that is around autonomous vehicles in the automotive sector, you're probably, a little bit more reluctant these days to invest in this vision or this future bet than others. But I would not say that we, totally not changed our investment criteria.
Mm-hmm. And in terms of terms and conditions that affect the term sheets or the investment agreements, have you seen any adjustments? So we were mentioning earlier the valuation that probably will follow what we've seen on the public market. Any more terms that are investor friendly? So we were pre-COVID in a very founder friendly environment. Do you see new clauses, new terms, new conditions that are resurfacing in downturn periods?
Definitely, because I think what you get now, what you receive now is risk capital. It's simply at the moment to invest into a company in the mobility space. Let's say it's a higher risk than what we have if you would have invested a year ago. And with that, investors try to secure their terms to get their money back in a downturn case. So I think the downturn protection in the sense of leak-pref for investors that get in now are more investor friendly than this was before.
So maybe for our audience, liquidation preferences, if things don't go as expected and the company is sold for less than what you invested, you would recoup your investment 1 times, but it can also be a couple of other multiples. We've seen 2 times your investment. So based on the proceeds, of course, of what you get at the exit. We've seen also anti-dilution protection coming more and more often, which basically protects you as an investor if the company is doing a down run. So if the price at which the next financing run is done is lower than what you paid for when you came into the cap table, so that protects also your shareholding. So that's something that I've seen also milestone investing. So you only get certain tranches if the company has achieved certain milestone.
Yeah, I think we see a lot of convertible notes rather than equity rounds these days, simply for the sake that this goes quicker with higher interest rates. and lower caps. So as said, I think generally we can say it is for a founder more expensive to get money these days in, and more unfavorable from a founder perspective, but also from a first-time investor perspective. So because of course when you have invested a year ago and now a new investor comes in, that's also dangerous. So for us, for the seed rounds, we have not really, tightened our terms or made our terms stricter from what it was before when it comes to liquidation preference or those types of things.
And do you think that there is a difference between stage? So like you would see more of these terms and more impact at later stage, so series B or C?
Yeah, I think that's definitely the case. And this is also because simply stage-wise, the risk is higher. So what we can see is with early stage investments, and they are not as hard hit as a company than the later stage. Simply because, if you are early on, you just raised $1 million, let's say, and you're not generating any revenues yet. You don't have, you have only 5 people in your team with very low cost, fixed cost. There is also nothing to lose. I mean, there is no revenues that you could lose. Whereas with the later stage companies, it is really, really difficult. You cannot control your top line results all of a sudden. It's not in your control anymore. Because if your customers go bankrupt or they are not paying you anymore and you cannot get in your invoices and your receivables, that's very tricky. The only thing that you can steer these days is on the cost side, and that's a high risk, because then all of a sudden you stop your growth if you reduce the costs to the minimum possible. So I think there is a reason for very early stage startups, if you have a secured runway in the sense of you just closed a round, usually you are safe with very easy measures to extend that runway to 18-24 months, and I think that's long enough to hopefully, that we have a recovered situation.
And looking at the sectors that you're specifically in, would you not say that, for example, because they have like quite capital intensive, I mean, we're talking about machinery, there's a lot of cash stuck into this more hardware. Does that mean that it's also more difficult for them to ride out a crisis than a pure software B2B company?
I mean, we do not invest in hardware. Maybe there was a misunderstanding. I mean, it is the software that maybe, if it's predictive maintenance, then it is the software that would more or less process the data that comes from the machine of the customer, but it is not necessarily that you have to own the machine. That wouldn't work. But in general, yes, I agree. Of course, the more assets you sit on and the more bound capital you have, the higher the risk and the more tricky it is.
And in your space of Industry 4.0, where would you, like if a founder was coming to you with a new deal, where would you put your money? Is it, more on the
logistics and supply chain? Yeah, clearly. We're looking in that space for a long time because we feel there is lots and lots of efficiency improvements still to be gained. However, it is a very low margin area, and it is very hard to, with the technology, come to a positive business model there. But overall, I think that's still a very, very interesting area, and somehow the supply chain is still not really connected. There's still not enough transparency of the different players in the supply chain, and a huge potential to gain efficiency.
Yeah, and I mean this sector, because I'm also investing a little bit in there, it's been quite, I would say, positively affected by the COVID, because it's request and accelerate request and ask for the players to accelerate their digitalization, to be able to supply all these products in a timely manner, as we've seen, especially on the food side and the grocery side. But when you're talking about supply chain, what type of solutions are you looking into? Are we talking warehouse automation? Are we talking inventory management system? Are we talking traceability, transport?
Yeah, I think I wouldn't exclude any of these. We are really, I mean, the tracking tracing is definitely something that still we don't see any solution that works globally out there in a profitable manner. So that's definitely something to come, and where we closely look at. On warehousing, I think, and intra-logistic solutions, there is quite a bit already going on, but also there's still a lot to be improved. And I think the market is huge, so there is room for different players. I don't think this is going to be a winner-takes-it-all game, but there is so many different industrial players with different warehouse constellations and requirements that definitely also several players can survive and can come up there.
Mm-hmm. And so in that case, when would you be where would you think the new normal is back, and where we see like new investment being done? And having kind of a way back to normality. Do you think this is something that you were mentioning, the scenario testing that you were doing with your portfolio companies? I guess we all talk about the V curve, the L curve, the U curve. Where do you see the society, the economy back to normal in your crystal ball?
It is really a difficult question, and we had our analyst calls today with our LPs that are all in the, coming from the traditional industries. And overall, I think that people are quite positive these days for a rather fast recovery. And coming back to normal when it comes to production capacities and restarting, let's say, normal production. However, the recession as a whole, and especially we also invest in construction tech, how this will hit long-term the overall demand level, that's definitely something very hard to predict at today, from today's point of view. Especially, on the construction side, we haven't seen a lot of discontinuation there. However, it will depend also very much on state initiatives, infrastructure projects, how much money they gonna put in there, what's gonna be the overall level of the construction industry in, let's say, 2 years from now. But as said in the very beginning, overall, I really, really believe they are all striving for technologies to, make them more innovative, make them better than others, make them quicker, more cost efficient, with more customer centricity in order to be closer. And this is all, these are all possibilities and opportunities for young entrepreneurs to find a market.
Mm-hmm. Perfect, thanks a lot. I'm going to stop here to also probably let our audience ask you a question, Marie-Hélène. I would just finish on that note, that it's great to see the optimism and the positivity that you bring to the stage, knowing that we've been through kind of 2 months of difficult time for founders. I would also note and summarize that you would advise founders to really look at their cash situation and runway, and to extend this as much as possible, because the probable investment ecosystem at this point in time is not a very founder friendly. But on the other hand, for the investors that are around the table today and in the audience, that might be also an opportunity to do great deals. But there is also like a lot of opportunities, since this crisis have accelerated the digitalization of a lot of different sectors, especially your focus sector like industry and construction tech. So quite a lot of innovations are awaiting there. And I would finish on that note and hand over to Ulrike, my co-director, who has gathered the audience question and can now moderate through.
Yes, thank you, Sabine. We have quite a few questions in the Q&A box, but I would like to encourage you all to still write questions inside the box if you still have some in your mind. But let us start with the first one. Marie, how important do you feel a well-managed cap table is? And would employee share plans being implemented be something that would encourage funding? I think it's especially nowadays compared to before COVID.
Okay, so always a well-managed cap table is super important, and even more important in early funding rounds. So keep it as long as possible, as clean as possible is always really something we would recommend. Be very careful in, bringing in too many different players, and also early on giving too many, even on founder level, involving too many people. Especially what is a no-go is if there is equity with passive founders. That's always something we are very skeptical about, because we want the incentivation of equity being with the people who drive the company forward. Employees share plans, so that's a recommendation and also a hygiene factor. We even ask for that at least a pool of around 10% of equity would be allocated to option plans or employee share plans that can be deployed along the way. Especially these days, I think, in the crisis, if the question goes in that direction, as said by Sabine before, what we have seen a lot is trying to reduce and bring down cash out components, and salary is usually 90% of the cost structure that the startup would have in the early phase, and try to compensate and incentivize the people more with participation on the company success and the equity. So yes, definitely, I think it becomes even more important as a factor in the future.
Mm-hmm. You already mentioned it now, the buzzword no-go, and we have here one question about what are no-goes in company pitch decks, and what are topics in pitch decks which bring you to reply to the founders, especially nowadays? Mm-hmm. So what rises your attention at the moment when you get a pitch deck?
So what always rises your attention is traction. So if you see that someone has found product market fit, and there is a very accelerated growth in the development of the revenues, or at least the conversion into continuous contracts, that's definitely something you would pick up. In our specific industry, we are really fighting, and our startups are fighting a lot with pilots. So I think it's clear that pilots are not a guarantee and an indication that you have found product market fit. there is lots of budgets for innovation projects with the big corporates, and therefore it's very easy to, or not very easy, but sometimes quite easy to get into a pilot project, but that's not a signal or indication that this is a proof of product market fit and a growth there. So what's no-go in the pitch deck for us? I'd say, you know, we are single founder, something where you feel there is someone talking just about him and how he built the company and everything around, you know, a one-man show. That's a little bit a no-go. Then if the hygiene factors are not met, so if you know if you have inconsistent numbers on page 3 and page 5, of course we are lacking then to take this serious, and obviously that's not meant serious. I don't know. Anything else, Sabine? You are also looking at all.
No, actually...
maybe one. Maybe you find out one no-go, especially at this time, at the time of the crisis. Maybe something changed now.
Maybe one question on this, Ulrike. Exactly on the COVID. Do you require now founders to have in their deck a COVID impact page, and how this has affected them, or how they've been impacted in terms of business plan or measures that they took? Is that a requirement or prerequisite for you to actually see the trust or the
yeah? So I think it depends on the stage of the startup. I mean, as said, we are even investing in pre-seed very, very early on. So these days I would receive, if I would receive a pitch deck, I would assume that they have planned their go-to-market and their product already in the new normal, under new normal conditions. If it's a follow-on round of someone that has been on the market, definitely, I think that's part of doing your homework, to share your insights, how COVID hit you and what were your countermeasures and why you might feel that this is an opportunity.
Mm-hmm. Mm-hmm. We have one more question that is a bit connected to this question before, and you already mentioned it a bit in the fireside chat. Do you recommend young entrepreneurs to launch and start their business now within the crisis? So you already talked a bit about the different layers and sectors you are investing in, but maybe you can add something here.
Yeah, I mean, first of all, I always think, you know, a crisis makes you stronger. And if you have an idea and you believe in that idea, that this is a good one, unless this is now really totally, you know, I mean, if it's probably in the hospitality industry, but even there, you know, new opportunities arise and new chances now come up in this crisis situation. So I deeply believe if you have your vision, if you have your dream, make it true. There is enough money out there, and I'm a total optimist that again the whole COVID will accelerate digitization and might even help to make things realize and come true quicker than maybe before. So yes, I would do so. Of course, if your target segment is one that is severely hit and a segment that is also sustainable hit long term, I think it makes sense to first reconsider, readjust maybe a bit, and come with a adaptive plan to the market.
Mm-hmm.
I also think, Ulrike, maybe that the COVID has also triggered or made us acknowledge, especially maybe on the hospitality, of certain inefficiencies. And I think if like some young entrepreneurs are looking for ideas, they should look at what has this crisis revealed in terms of inefficiencies in supply chain, in food ordering, in the restaurant industry, in traveling, in things where we, because never thought about it or never had time to pause, revealed a couple of discrepancies where a solution could be actually valuable. So maybe that's an area, that these are areas where I would look into.
Yeah, that's so far from the questions from the audience, but I would like to add one question from my side at this point, maybe also to both of you. If you would now start your startup, what idea would you go for, like making a prognosis for a big chance in the future after Corona? From your perspective as an investor.
That was not the plan, Ulrike.
That's not on my sheet, sorry.
But if I would write it in the Q&A box, I would have asked it anyway. So
yeah, no, it's a good question. I'm always asking myself, if I was not investing in startups, what type of entrepreneur would I be, and what type of business would I run? And I'm always amazed by the entrepreneur that we found. I mean, this is also something where you need to have admiration for all these guys who are putting a lot of their time and resources to build something that they're passionate about and that they believe that could solve a real issue. I have to say that if we're talking about COVID right now, I would say anything which is about cost optimization. So every tools that can provide a good overview of your cost structure and how you can optimize it in a certain way. So I've looked at certain companies, for example, who are looking at revenue leakage in stores because out of stock, because operational issues in the stores that doesn't bring the product as it should be, and so it's not selling as it should be. And we have a couple of companies in the portfolio right now which are, due to COVID, extremely in demand because the store managers wants to know as quickly as possible what are the operational issues that prevent them from selling as best. And this can be as easy as the product is not in stock or the product is misplaced or the promotion is not applied. And there are now tools that bring this to life.
Mm-hmm.
I think I have two areas. One is, we have via COVID on each single personal basis a huge learning curve that the online world is there. It's possible to communicate online and virtually, to sell, to buy. Even grandma who never ordered online is these days ordering online. And I think we have plenty of small industries. Look at, a handcraft worker, the plumber, or they are all not digitized yet. Their connectivity to the end customer, how to sell to them, how to serve them, how they try to find them, and the other way around is still a very today manual process. I think this is an area, if you do it smartly, you can very quickly come to quite a good increase. So we invested in one startup, Schüttflix, just recently, and it's a marketplace in a very traditional industry, bulk materials, how you bring bulk materials to the construction site. It was a very regional business. And there were a couple of pain points associated, and it was a very super simple approach and application that you can now order at the construction site your bulk material to the spot where you need it with an app with 2 clicks is simply booming. And I think this Schwellenangst, this problem that a lot of traditional industries had, to enter the online world, this is something that we have overcome now. And the second area where I probably would invest or where I would found even a startup is in the area of education. I think what we have now seen with schools happening in Germany, how digitally illiterate they are, how completely, you know, they failed in such a situation to continue with education for months now is really a tragedy. And I really, really hope that this was the wake-up call to also the government to invest heavily into this area. And therefore, if you are supporting that, I hope funding will be enabled.
Great. Education tech, perfect. Well, thanks a lot, Marie-Hélène and Ulrike. We don't have any further question, right?
No, we are finished with the questions.
Perfect. But Marie-Hélène, I would like to thank you so much for your time and for being our first guest speaker in our first virtual fireside chat. I hope our audience have got great insights on the fundraising activities, on entrepreneurship, on industrial tech. I was very glad to be monitoring this with Ulrike, so I think that was a good event. I would like to therefore also thank my team behind the scene with Philip and Marie as well. There, of course, it's not yet done. We are going to repeat this format. Thank you, Ulrike. We're going to repeat this format for the time being, still virtually. Our next SG virtual event is going to be on the 20th of May with Anna Alex. You might know Anna from Outfittery. She was the co-founder of Outfittery and now CCO and founder of Planetly. So we're going to talk about sustainability. We're going to talk about climate change, and again, another woman on stage, which I'm very glad to welcome.
And the Speedinvest portfolio company.
And a Speedinvest portfolio company. We didn't know this. We should have done
it. See, a recent investment. We even invested after COVID. No, right before, I think. But yeah, it's
right.
Great. Then it's a good transition after having the investor perspective. We have the entrepreneur perspective and all this in the woman environment. So great. Thanks again, Marie-Hélène, and thanks to our audience for being with us tonight. And if you have any recommendations, feel free to reach out to us on how we can improve this type of formats. Looking forward.
Thank you very much for the invitation, and feel free to reach out. I'm reachable via my email, Marie-Hélène@speedinvest.com. Very easy.
Cool. Thanks a lot, Marie-Hélène, again.
Thank you very much.
Bye.
Bye-bye.